We understand better than most that you have more than just your retirement plan to worry about. Your employees are counting on you and the pressure is on. But don't worry, we're here to help. One of the services that we provide at Sentinel Benefits Financial Group is fiduciary training and education to retirement plan investment committee members and other investment fiduciaries. ERISA, or the Employee Retirement Income Security Act, protects the interests of retirement plan participants under federal law. This contains enforcement provisions for non-compliance, making it important for plan fiduciaries to understand their responsibilities. The purpose of this presentation is to not only familiarize yourself with ERISA, but to provide retirement plan investment committee members with the principles and practices of good fiduciary stewardship. So, who exactly is a fiduciary? A fiduciary is anyone who acts in a position of trust on behalf of or for the benefit of a third party. Because ERISA defines fiduciary not in terms of formal title, but rather in functional terms of control and authority over the plan, it's actually not all that uncommon for fiduciaries to be unaware of their status. But not knowing your responsibilities is not a defense. To be clear, if you exercise any discretionary authority or control over the management of a plan or its assets, render investment advice for a fee or other compensation, or have any discretionary authority or responsibility in the administration of the plan, you are a fiduciary. In order to better define who a fiduciary is, it's important to understand three crucial roles. An investment steward, typically a trustee or investment committee member, has the legal responsibility to manage all investment decisions by determining asset allocation, defining the details of the plan strategy, implementing the strategy with the appropriate investment managers, and monitoring the strategy on an ongoing basis. An investment advisor is a professional who is responsible for managing comprehensive and continuous investment decisions. And an investment manager has discretionary rights to select specific securities for separate accounts, mutual funds, commingled trusts, and unit trusts. What is most important to remember is the fact that fiduciary liability is not determined by investment performance and outcomes, but rather whether or not a prudent process was followed by any combination of the investment steward, advisor, and/or manager. Basically, a fiduciary should know and understand laws and trust provisions, diversify assets to the specific risk-return profile, prepare an accurate investment policy statement, or IPS, use prudent experts, like an investment advisor, to document due diligence, monitor the activities of said prudent experts, control and account for investment expenses, and avoid conflicts of interest and prohibited transactions. In order to avoid conflicts of interest, investment stewards should always ask who benefits most from the investment decision at hand. If the answer is any party other than the plan participant, the steward is likely to be committing a fiduciary breach. Some examples of possible breaches are as follows. If a friend, business associate, and/or relative stands to benefit at the expense of a participant or beneficiary. An investment steward uses the assets of a private trust to provide unsecured loans to related parties and/or entities of the trustee. An investment steward hires an investment manager for a reason other than qualified merit. An investment manager uses soft dollars for any purpose other than the purchase of investment research. Please note that soft dollars are a means of paying brokerage firms for their services through commission revenue, as opposed to through normal direct payments or hard dollar fees. Bottom line, no matter who you are, being a fiduciary is all about trust. Section 404 of ERISA imposes a prudent standard of care on the employer and other plan fiduciaries that is comprised of 5 separate principles. 1. A fiduciary must discharge a duty of loyalty to plan participants, and therefore must avoid conflicts of interest when managing plan assets. 2. The exclusive purpose rule states that a fiduciary exclusively provides benefits to participants and their beneficiaries while paying only reasonable expenses for the administration of the plan. 3. The duty of care states that a fiduciary must act with the care, skill, prudence, and diligence that a prudent man familiar with such matters would act in a similar capacity for like aims. 4. There is a duty to diversify the plan's investments so as to minimize the risk of large losses. And lastly, 5. the duty of obedience that burdens a fiduciary to act in accordance with the documents and instruments governing the plan to ensure they are consistent with ERISA. So now that you know that you're a fiduciary, how can you ensure that you're acting as a good one? Our 4-step process will help. Step 1, organize. Step 2, formalize. Step 3, monitor. And Step 4, implement. As in managing any financial decision, organization is key. The investment steward is responsible for setting definitive goals and objectives that are consistent with their portfolio's current and future resources, the limits and constraints of applicable trust documents and statutes, and the needs and requirements of plan participants and beneficiaries. The steward should collect, analyze, and review all of the documents pertaining to the establishment and management of the investments, including a copy of the IPS, written minutes and/or files from investment committee meetings, applicable trust documents, including amendments, custodial and brokerage agreements, service agreements with all investment management vendors, custodians, money managers, investment consultants, actuaries, accountants, and attorneys, investment performance reports from the investment advisor, investment manager, and/or custodians, and information on the investment advisor if one is retained. All documentation must be filed in a secure, centralized location. In order to formalize the process, an investment horizon is established, a risk level is identified, an expected modeled rate of return is identified, selected asset classes are consistent with the risk, return, and time horizon, and there is an IPS that contains the details to define, implement, and manage a specific investment strategy. One of the most important decisions the steward has to manage is the determination of the portfolio's time horizon. In the case of a defined benefit retirement plan, the appropriate asset liability study should be factored into the time horizon. In the case of a defined contribution retirement plan, such as a 401k or 403b, the investment options must address the range of participant time horizons. Once the time horizon has been considered, the investment steward can then determine the asset classes to be considered, the mix among the asset classes, the sub-asset classes, and finally the money managers or mutual funds to select. The level of risk in a portfolio must be wholly understood, and all the quantitative and qualitative factors that were considered must be documented by a prudent expert. It is the due diligence of a fiduciary to be sure that all decisions that were made to create a risk level were noted and the set process was followed. Additionally, the selected asset classes must be consistent with the risk, return, and time horizons set by the participants. This allows them to diversify appropriately based on personal financial planning goals and timelines. Remember, the same methodology and process should be effective and consistently applied. As a side note, within the IPS, there must be a clear definition of the duties and responsibilities of all parties involved in the process. The IPS also defines the guidelines for diversification and rebalancing that are within the parameters for specified risk, return, time horizon, and cash flow set in the beginning. There is due diligence criteria for selecting investment options that are clearly outlined, as well as monitoring criteria for investment options and service vendors. And the IPS will outline procedures for controlling and accounting investment expenses. Lastly, the IPS will define appropriately structured, socially responsible investment strategies. The investment strategy that has been designed will be implemented in compliance with the required level of prudence. A procedure for selecting investment options must exist, and more importantly, it should be followed and consistently applied in all scenarios. When selecting an investment vehicle, it is important to consider which are most appropriate for the targeted portfolio size. Some of the factors to consider in the selection of the investment vehicle are ease of liquidity, minimum required investment, the degree to which the investment is diversified, the ease in meeting asset allocation and rebalancing guidelines, the ability to perform the appropriate due diligence, flexibility in adjusting fees for growing portfolios, and the degree of regulatory oversight. The fourth and final step of our 4-step fiduciary process is to monitor. After all decisions are made and the processes are in place, it is imperative to monitor reports and compare investment performance against peer groups indexes, and the original IPS objectives. Some things to be mindful of are the performance of each investment option, the information that is provided in performance reports, maintenance of watch list procedures for underperforming investment managers, and rebalancing procedures. Documentation is extremely important in the case of plan auditing, plan review, and due diligence as a plan fiduciary, so be sure that all of these tasks and topics are documented and monitored. Moving forward, periodic reviews and evaluations of the qualitative factors that would impact investment managers and investment advisors must be performed. Any unsatisfactory news regarding an investment manager and/or investment advisor must be documented as well. These notations should be reviewed, analyzed, and acted upon in a timely manner. In addition, control procedures should be put in place to periodically review policies for best execution or practices in securities transactions. Soft dollars should be reasonable in relation to the value of services rendered and should only be expended for brokerage research and for the benefit of the investment program. Fees to ensure these are consistent with agreements with applicable laws. And lastly, there must be a process to periodically review the organization's effectiveness in meeting all fiduciary responsibilities. If you have any questions on fiduciary standards or what responsibilities and practices a fiduciary is held to, feel free to contact your plan advisor at Sentinel Benefits Financial Group. We're always here to help with anything you may need to implement best practices and to uphold an excellent fiduciary standard at your company. Advisory services are offered through Sentinel Pension Advisors, Inc., or SPA, an SEC-registered investment advisor. Sentinel Benefits Financial Group is the brand name for the Sentinel family of companies, which includes SPA. Diversification neither assures a profit nor guarantees against a loss in a declining market. There are no assurances that any strategy will meet its objective.